According to official media reports, at the State Council executive meeting on April 18th, Li Con, Premier of the State Council, emphasized the need to continuously stabilize the stock market and promote the steady and healthy development of the real estate market. Such statements are nothing new, frequently appearing in various meetings. However, the context this time is notably different. On one hand, this was followed by another crucial point. Once relevant measures are introduced, they should directly benefit enterprises and the public, with enhanced implementation efficiency to ensure effective results. On the other hand, this marks the second mention of the real estate market within just 3 days. The previous instance was on April 15th during Li Qiang's inspection tour in Beijing, where half of the official statement focused on real estate. For example, it was pointed out that at present and in the foreseeable future, China's real estate market still has vast development potential. It is necessary to further unleash market potential and promote the steady and healthy development of the real estate market. The repeated positive signals regarding real estate within 3 days carry two implications. First, the real estate sector plays a vital role in stabilizing the economy, necessitating continuous emphasis. Second, it indicates that the current performance of the real estate market falls short of expectations. Although cities like Hangzhou, Chengdu, and Shanghai have witnessed frequent land king auctions, these isolated cases do not reflect the overall health of the national real estate market. Nationally, developers remain hesitant to invest. After several years of decline, the growth rate of national real estate development investment in the first 3 months of 2025 continued to drop by around 10%. The primary reason for this reluctance is the mediocre performance of new housing sales, which fail to incentivize developers. According to data from the National Bureau of Statistics, in the first quarter of 2025, the sales area of new homes declined by 3.0% and sales revenue by 2.1% despite a low base. CRIC statistics show that since October 2024, the year-on-year decline in monthly commercial housing sales area has been below 5% for 6 consecutive months, the first such occurrence since the second half of 2021. In March, 34 cities saw a halt in the month-on-month decline in first-hand housing prices, reaching a new high since the second half of 2023. Housing prices in first-tier cities stabilized earliest. As of March, the price index for newly built commercial housing in first-tier cities had shown positive growth for 5 consecutive months. Second and third-tier cities lagged behind, with second-tier cities' new home prices remaining flat month-on-month in March and third-tier cities experiencing a 0.2% decline. While there are signs of a potential bottoming out, it remains uncertain how long this situation will persist. Consequently, various speculations have emerged, such as rumors of restarting an expanded version of the shantytown renovation program. These include upgrading urban village renovations in 21 megacities to shantytown renovation 2.0, accompanied by 300 billion yuan in PSL-pledged supplementary lending special loans, local governments potentially purchasing over 1 trillion yuan worth of existing housing, and the central bank reportedly considering creating a new lending facility for rental housing. These speculations are not unfounded. Currently, while some first and second-tier cities experience a housing market recovery, third and fourth-tier cities, where most of the real estate inventory is concentrated, remain sluggish. Reviving the overall real estate market solely through first and second-tier cities is unrealistic. In fact, these cities are siphoning off purchasing power instead of boosting lower-tier markets. To stimulate the third and fourth-tier real estate sectors, the monetary-based shantytown renovation approach seems inevitable. Demolishing old buildings and constructing new ones not only stimulates existing demand but also creates new purchasing power, driving related consumption. The shantytown renovation launched in 2015 was highly effective but significantly increased household debt. If economic growth could keep pace, inflation might have helped diffuse the debt burden. However, since 2019, a series of unforeseen events have led China down a different path, leaving lingering economic challenges. Therefore, restarting a nationwide shantytown renovation would be a risky yet potentially decisive move. Amid the critical stage of the China-US trade conflict, domestic demand is crucial for economic stability, and a healthy real estate market is essential for this support. Some may ask, what about the stock market mentioned in the State Council meeting? Indeed, stabilizing the stock market is equally crucial. Since the start of Trump's tariff war, the national team government-backed entities has been aggressively injecting funds into the market. In recent days, the share market's resilience can be attributed to their efforts. For instance, on April 15th and 16th, the national team entered the market in the last 20 minutes, boosting broad-based ETFs and turning the indices positive. A clear pattern has emerged. Whenever the market performs poorly, the national team steps in during the final minutes, causing a surge in broad-based ETF trading volume and reversing the market trend. The situation on April 18th was similar. In the last 20 minutes, the national team actively bought broad-based ETFs, lifting prices from a 0.2% decline to a 0.37% gain. Initially, it seemed like a routine operation to meet performance targets. However, in the final 4 minutes, as the national team attempted to push up the ETF prices, a massive wave of sell orders suddenly emerged. The more the national team bought, the stronger the selling pressure became, leading to a sharp collapse in the upward trend. This triggered a domino effect, causing broad-based indices and the Shanghai Composite Index to turn negative. Ultimately, it all boils down to an age-old problem. Despite the continuous entry of the national team state-backed investors into the market, a significant amount of capital is engaged in arbitrage trading. In simple terms, investors borrow funds to buy the 50 ETF or 300 ETF before 2 p.m. and then sell them en masse at the market close, repaying the borrowed funds on the same day, often incurring no interest charges. This phenomenon is hardly surprising. The national team's trading patterns are so obvious and predictable that it's almost impossible to avoid attracting the attention of other market participants. It's like leaving a gold bar on the street. With so many people passing by, it's hard to expect that no one will be tempted. This situation also signals the share market's lack of sustainable momentum. The market has seen a rising index without actual gains for many investors. Despite massive injections of capital and numerous attempts to boost the market, it remains stuck at around 3,200 points, and this seemingly positive performance may be illusory. There are concerns that the national team's support may soon reach its limit, leaving the share market vulnerable in the coming week. Meanwhile, the US stock market is also in turmoil. Amidst the ongoing volatility, the conflict between US President Donald Trump and Federal Reserve Chair Jerome Powell has escalated dramatically, further heightening market tensions. According to media reports, Trump has been privately exploring the possibility of firing Powell for months, but his team remains divided on the issue. The White House later confirmed that Trump and his advisors are indeed studying the feasibility of removing Powell from his position. A public feud between a US president and a Federal Reserve chair, potentially leading to the latter's dismissal, would be a first in American history. If Trump initiates the process of removing Powell, it could trigger a global financial earthquake, dealing a severe blow to the US dollar, US treasuries, and US stocks. It may also prompt credit rating agencies to downgrade the US's national credit rating. In Goldman Sachs' extreme scenario predictions, a Federal Reserve that succumbs to political pressure and cuts interest rates sharply despite inflation risks could lead to a collapse of confidence in the US dollar system, driving up the price of gold. Nomura Securities pointed out in a recent report that Trump's public criticism of the Federal Reserve could disrupt the interest rate cutting process and raise inflation expectations, potentially causing renewed instability in the US Treasury market. French Finance Minister Bruno Le Maire warned that if Powell is removed, the credibility of the US dollar will be at stake, increasing the cost of US debt repayment and plunging the US economy into severe chaos. Why is the risk of a US president removing a Federal Reserve chair so significant? The answer lies in the lack of historical precedent. The Federal Reserve, the central bank of the United States, has its roots in a private sector structure and remains a semi-official, semi-private institution today. This unique nature stems from the birth of the United States as a confederation, where states held significant power and were inherently wary of excessive federal authority. In the early days of the US, people were so concerned about the central government's power that they preferred to endure financial crises rather than establish a powerful central bank that might infringe on state rights. The predecessors of the US Central Bank, the First Bank of the United States and the Second Bank of the United States, were both abolished after only 20 years due to public opposition. From 1836 to 1913, the US experienced multiple financial crises, but still refrained from establishing a central bank. It wasn't until around 1913 that the states reached an agreement to create a semi-official, semi-private central bank, the Federal Reserve. Since its inception, the Federal Reserve has been designed to be highly independent to ensure it remains free from presidential interference. This is because every president may be tempted to misuse monetary policy for short-term political gains to boost their popularity. The term of a Federal Reserve chair is for years, nominated by the president and confirmed by a majority vote in the Senate. However, removing a Federal Reserve chair requires the approval of at least 2/3 of the senators, and the grounds for removal must be limited to inefficiency, neglect of duty, or malfeasance, not policy disagreements. Trump argues that Powell's refusal to cut interest rates constitutes inefficiency and neglect of duty, but most observers consider this merely a policy difference. For Trump to successfully remove Powell, he would need the support of at least 2/3 of the senators or resort to a ruling from the Supreme Court. Given that 3 conservative justices appointed by Trump serve on the Supreme Court, there is a possibility they could support his move. If successful, Trump would gain greater influence over the Federal Reserve. Moreover, regardless of the outcome, the mere initiation of the removal process could raise concerns about the US's national credit, causing widespread market turmoil. Although rumors of Trump's intention to fire Powell have circulated before, this time the confirmation from the White House makes it a more pressing issue. Investors should closely monitor the US dollar's performance. A continued decline could indicate that the market is starting to react to this news. The US stock market's late session sell-off on Thursday was directly attributed to Trump's repeated attacks on Powell. The situation escalated further on Friday, but as most global markets were closed for the day, the full impact remains to be seen. Even if the market is aware of this risk, accurately pricing it is extremely difficult due to its potentially far-reaching and significant consequences, similar to the situation during the trade war. Looking back at the trade war, even though the market had a month's notice before its onset, it still couldn't prevent the subsequent market collapse.